let's welcome in our market guest for today, Mayuresh Joshi from Angel Broking joins us. Good evening, Mayuresh. Good to have you on the show. After that geopolitical news flow day, as far as expiry day was concerned, we saw that big cut, but after that we've done most of the recovery. But having said that, we have remained within this range, and 8800 has been some bit of a resistance zone. In terms of levels, what are you tracking in the near term, given that we'll be approaching a holiday period over the next weekend? It'll be a long weekend as well. And in terms of options premiums also, there's expected to be some decay. So we'll reach somewhere around the middle of the October series. How do you think things are shaping up, given that we have an earnings season also coming forth?
Good evening. So I think if you look at the larger picture, the medium and the long-term outlook obviously remains very, very robust for an economy like India, because we are very well placed when it comes to the reforms processes initiated by the current government and what has happened with our forex reserves. I think they're one of the best. However, from a short-term perspective, the global volatility will keep taking toll on global equity markets, including ours. And the kind of overhang that one probably perceives the US presidential elections to start playing out on the equity markets across the globe will be evident. Having said that, probably I think such turbulent times and volatile times, and the markets do correct from the current juncture, my own sense is that it makes prudent sense to start investing in Indian equities in a very staggered manner. The approach has to be stock specific and bottom up, where valuations still seem far reasonable rather than stretched at this point of time. So it's going to be a stock pickers market at this juncture. And earnings, as you rightly said, I think earnings will be key, but nobody's expecting earnings to probably improve before Q3. So I think Q3, Q4 is when we really expect earnings to probably start reviving. And then for a larger part of FY18, our own sense is that a 14-15 earnings growth not ruled out, plus a recovery in the private capex cycle over the next few quarters. So that augurs well for an economy like India as well.
Right. Mayuresh, a word on the bank nifty as well. I mean, in terms of levels, what will you be tracking? Because 20,575 was the recent high that we scaled in the September series, and post that, in a jiffy, we've really corrected almost 1,200 to 1,300 points. Today was, of course, the weekly expiry. Owing to that, we saw some bit of gyrations in the second half, and we ended around 150 points lower, just below that 19,400 level. For the bank nifty, what levels will you be tracking, and would the bias remain on the public sector banking side?
So largely, I think if I split the banking industry into two, between the private and the public space, the private players have done exceptionally well over the past few quarters. Within the private space, I think if you split that down into two again, between the corporate and the lending book side, or the lending retail-oriented banks, the retail-oriented banks have given a much stable performance. However, I think our own sense is that the kind of asset quality pressures that we witness specifically for the banking industry and in the private space in general, the bottom-out process should start happening over the next couple of quarters. What this effectively means is the kind of credit costs which remained elevated for the banking industry as a whole would start tapering off over the next few quarters. And as credit growth starts picking up, the entire onus of NIMs and spreads improving is an obvious conclusion. Having said that, probably I think on the public sector space, I think the top tier public sector banks, in my opinion, are still looking good. Again, the operational performance in terms of recognition of asset quality issues on their balance sheet, of increased provisioning continuing for at least a couple of quarters going down into FY17, I think might persist on the balance sheet. But again, I think they're much better placed compared to the mid and the smaller public sector banks, where capital adequacy also remains an issue. So yes, I think the bias remains with the larger private sector banks and selectively with large public sector banks.
Fair point. Let's focus on sectoral action today. Refiners were up in trade. Two reasons and two factors behind it: the Saudi discounts resumption to the refiners, as well as the GRMs improving. And we've seen gasoline deltas revive quite significantly. Piyush is standing by with those details and what was driving the refiners in trade today. Piyush?
Absolutely. Last month we saw Saudi Aramco actually reduce the discount, and again this month what actually we are hearing is that Saudi Aramco has increased the discount. Now Aramco is an oil producer. Now oil producer basically sells the oil to the refiners, which means refiners like Indian Oil, Reliance Industries, HPCL, BPCL, Chennai Petro, they all are going to benefit from this. Now what the significance of this news is that Iran, Iraq, Kuwait, they all actually are competing for the same market, European market and the Asian players like India. So which means if Saudi is actually offering discount, the other players will also have to offer higher discount. Let's remember, Iran and Iraq, they have been the last suppliers, and both actually are now the top 2 suppliers for the Indian market. So in this context, if we see what actually Saudi has offered, Saudi actually has cut by 25 cents per barrel on the Arab light price. Arab medium price has been cut by 10 cents, heavy price has been cut by 50 cents. But what is more significant here is that what is the cascading effect it's going to create for the other producers like Iran and Iraq, and that's why the refiners are reacting. Now, the second news is also very interesting, which is that the Q3 GRM should be much better for the refiners, as in what we are seeing over the last 2 weeks. The Singapore cracking margins, they actually are near 6-month high. This margin we saw in the March, so which means after 6 months, the GRM, the gross refining margins, are looking much better for the refiners. The reasons are actually the gasoline cracks, they have recovered again to $8 per barrel. The diesel cracks, which actually has remained resilient over the last 2-3 months, while the gasoline cracks, they had fallen. So now the recovery of gasoline plus resilience of diesel means that overall GRMs are looking much better. Also remember, because the fuel oil cracks in the Asian side, they actually have remained strong, and because of that, the heavy oil cracks have also been very good, which is very good for the heavy oil refiners like SR, like Reliance. They actually are going to benefit much more. Overall, if we summarize, for the refiners, it's a very good day, a very good news, both from the GRM perspective, and also they should be expecting higher discount, which actually is going to flow into the GRMs again.
Mayuresh, what would your view be on some of these refiners? I mean, it has been quite the flavor ever since diesel deregulation has come through. But having said that, Reliance Industries as well as SR, I mean, of course, unlisted now, but their refining factors and the refining ability is quite solid, and they have had a lot of procurement profile from Iran and Iraq, where they have procured cheap crude from. What would where would your preference lie among the 3 PSU refiners? And as far as Reliance is also concerned, and you see scope for GRMs improving upwards from here?
Well, yes, I think Piyush summed it beautifully. And again, if you look at the kind of trend that you're probably seeing on the GRM front, it's definitely going to have a benefit for the refining industry as a whole. Having said that, I think the OMCs have been in a sweet spot over the past few quarters, and a large part of the delta in their earnings as well as their price momentum has largely been captured because of no under recoveries on their balance sheets, debt going down, working capital constraints almost disappearing on their balance sheets. But I think the kicker for the stocks, apart from GRMs, which obviously is a key beneficial impact on their EPS and balance sheets, is also going to be how the marketing margins pan out. And the marketing margins on both petrol and diesel are expected to again inch up over the next few quarters, which will again add to their earnings over the next few quarters. Third, I think the kind of capex that these guys are putting in terms of complexities coming through, that will also improve their GRMs going ahead as these capacities start commissioning over the next 3 to 4 years. Again, it's a long drawn out plan, but with the kind of demand supply dynamics in crude that you're probably witnessing, one really expects crude to probably move in the range. So if one excludes the inventory gain loss component over the next few quarters as the price moves and becomes very, very volatile, my own sense is that OMC's operating performance and earnings performance will remain extremely strong. For the upstream, specifically for companies like Reliance, I think the kind of heavy and middle distillate refining complexes that they've got definitely aid in having their GRMs inch up. Again, I think the GRMs are far more superior to Singapore GRMs because of the existing factors, and again because of these push-through factors coming through, that improves their margins a whole lot. The petchem segment has been doing exceptionally well. What happens again on the telecom part, I think nobody's really taking into account any numbers, at least for FY17. With new capacities coming through, I think FY18 numbers for Reliance will largely look much better, as a whole host of their capex, specifically on the core as well as non-core business, is now largely behind it.
Right, from oil and gas, let's move on to a BTVi exclusive. We learn that JSW Steel has emerged as the front runner for a big steel plant acquisition in Italy. Swati Khandelwal Jain joins us on the phone line with more details. In fact, she just joins us live. Take us through who's the target and how big is the deal likely to be, and how does it fit into JSW's overall plans, Swati?
All right, let me answer all these questions one by one. First and foremost, this is a deal that JSW is looking at acquiring 10 million tons plant. It's an Italian plant which is owned by government. Ilva Steel is the name of the plant. Now remember, and if you recall, 2 years ago, JSW Steel had shown interest in this plant, But when they found more details on the pension liabilities and the environmental clearances, which were to the tune of in excess of 1 lakh odd crore rupees, they obviously retracted then. But now it seems that the Italian government has given them assurance to take on as much as possible all of these liabilities that we are talking about, and hence the interest has come back again. What we know from sources is that JSW officials visited Ilva facility very recently. This is in the final stages of due diligence that's ongoing at this point in time. In fact, the officials from Ilva also came to Mumbai a few days ago, and the final valuation is being worked out. Well, sources tell me that while the 10 million ton steel plant typically will be in excess of 10,000 rupees, but here is the deal clincher, and we understand that JSW deal could be paying just about $500 to $550 million for this deal, which is almost 1/3 the price which you would have otherwise had to pay for the plant of this size. Now, what is Ilva Steel and what does it do? It's a huge plant, and more importantly, it actually manufactures high-end automotive grade material of steel, which is given or is actually used by all the automobile majors in Europe. So you talk about the BMWs, all the German makes, Audi, BMW, Mercedes, everybody actually uses steel from this plant. So it's a very efficient and a big plant to really get into. JSW Steel, of course, as you asked, what are they likely to get from it? Clearly, the access to European market being one, because remember, they are not present there right now. They have presence only in the US. So their presence in European market is taken care of by this deal. Second, we know that the strategy really here that will work for JSW will be to use the iron ore mines. In fact, they have been bidding very aggressively, as we were talking to you and telling you on this channel. So they've been bidding very aggressively here for the iron ore and the raw materials. So they will make the steel products, the basic steel will be made here and then will be sold to European markets to actually give it a finished steel, final specialized steel, which will be sold in the European market. So that's the value chain that the company would be looking at working. Of course, they are one of the bidders, as I said, so it's not yet a done deal, but clearly from the assurances from the government, we understand that JSW Steel is emerging as a front runner.
Right, Mayuresh, specifically about JSW Steel, I mean, has been obviously the poster boy of among the steel fraternity with their expansion at Dolvi and the Vijayanagar Steel Works, which is also going on, and both are likely to reach 10 MTPA in the longer run. They've also expanded that jetty project as far as the Dolvi steel plant is concerned. What is your view for JSW Steel? And understandably, they have been the bigger bidders in this Karnataka auction that was recently underway, and they've got a whole lot of iron ore procurement and surety from there. Does it make sense at this point to go in for almost a 10 million ton acquisition target in Italy? Maybe obviously a difference between flats and longs is also important, because Tata Steel's Ijmudian is mostly flat products and they are doing well in Netherlands, apart from the long products UK business. Your view?
No, again, I think the kind of expansions that JSW has done domestically, I think it is going to be helpful and beneficial in the long run. Largely as a component that demand expected to come back strongly over the next few quarters. I think you're not seeing any strong signs of demand actually coming back, at least for the quarters that have gone by, even for the quarter that had gone by just now, Q1 FY17. So largely I think it's going to be more cyclical in nature in terms of how demand recovery takes place and what kind of utilization levels the domestic plants operate out of. The bidding that they're doing is an obvious conclusion, because they want to secure reserves and linkages for production of steel, and that again helps them in lowering the cost of production. For the overseas acquisition buy, again, I think it becomes a value add, but then what kind of debt gets added onto the book, added to the fact that on an EV/EBITDA basis at the current juncture, the stock is not cheap by any means. So A, one really must understand what kind of contours this deal really entails, and B, the kind of demand projections for the end user industries that JSW Steel basically supplies to. But at the current juncture, my opinion is that the stock has moved up significantly and valuations are looking very, very fair at this point of time.
All right, from end product to raw material, let's speak about NMDC. The company has undertaken price hikes for lump ore. It has undertaken a hike of 400 rupees per ton, which now stands at 2100 rupees per wet metric ton, and for Fines, they have again increased by 300 rupees per ton. So now the price up on your screen stands at 1760 rupees per ton. This is the biggest price hike that they've taken in the last several months. Prices for NMDC are now back to the April highs that they had seen. And this is pretty much in line with the kind of private miners price hikes that we've seen in Karnataka and the global price hikes, the global iron ore rally that we've seen as well. Obviously, what it hurts is the steel companies who obviously procure this iron ore, and coking coal also typically is a 20% portion of the operational expenditure. So both these prices have risen, and that has hurt steel companies over the last 1 or 2 months. Specifically, coking coal, which has reached almost $200 a ton, is a big drain. And if it's a non-coastal, it's a hinterland plant, all the more reason, because most of this coking coal is imported from, say, Australia or Indonesia, and then the logistical charges also add up to that OPEX. Let's go to Mayuresh with your view on NMDC, Mayuresh, because at one time the company used to make margins of 65%. It's almost come down to 50%. Do you expect some bit of recovery to come through in terms of volumes if it happens to sustain at these prices going ahead for NMDC?
Again, I think a sustained volume recovery will take time, in my opinion. And again, I think the kind of scenario that we've witnessed, iron ore prices have basically moved up from May, June, from lows of $50 a ton, right up till $60 a ton. So it was an obvious reaction for NMDC to probably go in for a price hike. Secondly, I think the kind of district mineral fund contribution that NMDC and the other miners have to make is also going to have a toll in terms of how their margins pan out, because somewhere that has got to get compensated. Last quarter's numbers were because of differential pricing and the hikes that had taken in the Karnataka region. And again, I think on the fourth aspect of their cash burns that they're probably doing at the steel business or the steel plant that they're putting up, I think that is also going to take a toll in terms of their capital ratios being subdued. So largely, I think not seeing an improvement in EBITDA margins probably going ahead. How EBITDA per ton functions over the next few quarters is an interesting composition. The dispatches in the last quarter were pretty good at 7.6 and 7.8 respectively. But largely, I think if you look at the kind of EBITDA per ton expected to improve significantly, my own sense is that it will be a very slow and gradual process. And again, I think the kind of dividend yields that you're used to, I think even that can get curtailed because of the cash burn that they're doing and the excessive capex on their balance sheet. So again, I think largely in the price at this point of time, I mean, I'm not expecting any significant move probably to take place on NMDC.
All right, Mayuresh, hold on. We'll take a very quick break, and when we come back, we discuss the Orient Cements and JP Associates deal in greater detail and more stocks to track.
Working girls in India don't really think anymore about being women. It's just about going out there with your qualifications.
There's a sort of inbuilt discrimination. We know it's there and we need to shoot through that glass ceiling.
The only way for women to actually come out on top is to really prove that they can deliver.
You got to wake up every day and be very mindful of the fact that you got to do something to move forward. Change comes when you have advocates of change. I want to be an advocate of change. How much? I don't know.
Action! They inspire.
Just think large, think sensibly in the present, and I guess we'll be able to pull it off.
They entertain.
When you're like 90 years old, be like, oh, I wish I took that risk.
They mesmerize.
हम शरीफ क्या हो ये सारी दुनिया बदमाश हो गई.
They are the newsmakers, the trendsetters.
The most powerful medium tell a story in this country is mainstream cinema.
Get up close with India's biggest stars.
I just hated the term hero and villain. We are actors.
We have to go ahead and be progressive.
I think something which is refreshing and got genuine story, that's gonna work.
Join us for conversations like never before.
जीते की चाल,
You have to act.
बाज की नजर,
You have to act.
और बाजीराव की तलवार पर संदेह नहीं करते.
By the time you blink your eyes, 50,000 orders get processed at BSE. BSE, the world's fastest exchange.
Pranoy is joining us with some exclusive details that he's picked up on JSPL and their endeavor to monetize assets in the real estate arm.
We exclusively pick up certain information, as you said, about the real estate arm now, Jindal Realty. The promoters looking to sell this to a Chinese company, Country Gardens, who held a meeting last week on this.
We also understand from sources that the company's promoters are looking at selling stake in the real estate business, which is Jindal Realty. Can you share some insight on this? Is this a correct assessment on our part?
So we are looking at various options whereby we can generate liquidity out of this business. It could be outright sale, it could be a divestment. So we are open to both the options, both of them being worked upon.
Track the biggest movers of the day. Stocks that are the biggest winners and the biggest losers. Stocks that markets are talking about. Get the sharpest and most insightful analysis from fundamental to technical. Catch market movers.
Welcome back. You're watching Markets Rewind, and let's talk about the ongoing theme of consolidation in the cement space. Orient Cements and JP Associates. Orient Cements, in fact, has notified their acquisition of JP Associates cement assets, and let's go through the particulars of this deal. So it's about the Bhilai JP cement unit, and it includes a clinker unit as well as a grinding unit. So the clinker unit is in Babupur, Madhya Pradesh, and that has a 1.1 MTPA capacity. The Bhilai cement unit has a 2.2 MTPA capacity. There's also the Nigri unit, which was commissioned only on the 3rd of June 2015, and that has a 2 million ton per annum capacity. So a 4.2 million ton of cement capacity plus a 1.1 million ton clinker capacity is what we are speaking about. If you talk about the BJCL unit, that's the Bhilai JP cement unit, Jindal JP Associates has 74% holding in it, and Steel Authority has the residual 26%. The commissioning of these units happened in December 2009 and August 2010 for the grinding unit. Now, if you talk about the valuations, and let's talk about the financials separately. The Bhilai JP cement unit that had a net worth of around 168 crores and a turnover of 400 crores. And if you talk about the Nigri unit, that has obviously recently commissioned, so the turnover was around 90 crores until the 31st of March 2016 is what we have. If you talk about the enterprise value, because valuation is also important for BJCL at 1450 crores, it comes out to a value of enterprise value per ton of $99 per ton, and enterprise value per ton for Nigri at 500 crores of enterprise value comes at around $38 per ton. Mayuresh, coming to you and going by the general yardstick that we've seen, we saw the Birla Corp and Reliance Cement deal happened. That happened at an enterprise value of almost $140 per ton. Then the JP Associates Ultratech deal happened, the big one, that happened at around $108 to $110 per ton. At $99 per ton and $38 per ton respectively for these units. Do you think it has come in at reasonable valuations for Orient Cements, and given that they'll get access to the eastern and central markets, and especially the Satna cluster, which is very important from a distribution and dispatch standpoint?
Oh yes, I think the foothold increases and the landscape increases for Orient, which predominantly had their plants in Telangana and the new commissioned 3 MTPA plant in Gulbarga. Having said that, probably I think the kind of valuations that they've probably got looks far cheaper than the earlier valuation and the replacement costs at the current juncture. But one really needs to also understand the quality of plants that are being taken over at this point of time, the aging of these plants and so on and so forth. So need to look into that in greater detail. But largely again, I think the deal is going to get commensurated with equal flow of equity and debt. What kind of increase of debt that has on Orient Cement's books is needed to be understood as well. So largely I think it does increase, as you rightly said, the kind of geographical foothold that Orient Cement will probably get with the deal. And again, largely again, it will also improve their capacity overall. Their existing capacity close to 8 MTPA, if I'm not mistaken. That again goes up by 2.5, 3 MTPA, along with the grinding unit as well. So I think it is a beneficial impact in terms of the realizations going forward as well, because it's an important cluster that you're talking about. But one again must need to understand the deals in greater detail. I have not gone through the entire document so far.
Fair point. We're going to leave it at that. But Mayuresh, always appreciate you joining us with your dissection of the markets and overall sectors as well, and hope to see you more frequently in future. Well, that's all we have on this edition of Markets Rewind. News and updates continue on the other side. Stay tuned.